So the other topic which related to the regulatory framework of the mutual funds. So this is a concept about the mutual funds. Investors pool their money with the fund manager. Fund manager invests in securities and securities generate the returns and pass it back to the investors. So regulatory framework of mutual funds. Ministry of Finance, which is related to the SEBI, Stock Exchange Board of India, as well as RBI, Reserve Bank of India, which controls the mutual fund industry in India, Association of Mutual Funds in India, Income Tax Regulations, Investors Association also there. So, first of all, what is the need to regulate a framework? So, mutual funds need to be regulated to overcome the investor manage the conflict of interest that might be arise. Such post-contractual opportunistic behavior can compromise the interest of the investors, expose them to risks such as the poor portfolio selectivity, which leads to the higher cost, higher portfolio risks than what was indicated in the offer document. Other organizational risks such as the delayed settlement of transactions, the regulator steps in to overcome such market failures with the objective of ensuring ideal type market conditions. So Indian mutual funds are regularly regulated by SEBI, whose regulations are quite comprehensive and qualitatively superior to those of many other countries. Reserve Bank of India. RBI role is to regulating banking industry in India, but as many mutual fund companies are backed by banks, so indirectly RBI has significant contribution and a role for safeguarding the interest of investors and other stakeholders in India. So in the year 1985, RBI permitted private sector institutions to set up money market mutual funds. They can invest in treasury bills, call and notice money, commercial bills accepted or co-accepted by banks, certificate of deposits and etc. So SEBI introduced several regulatory measures and amendments in order to protect the interest of small investors. SEBI Mutual Fund Regulations in the 1986 is the principal regulation for the mutual fund industry in India. This was amended several times, with the latest amendment being issued in the year 2002. So SEBI Mutual Fund Regulations 1996 as amended till date define mutual fund as a fund established in the form of a trust to raise money through the sale of units to the public. This imposes three limitations on a mutual fund and determines its basic legal character. So it allows the mutual fund to raise resources through sale of units to the public. It permits the mutual fund to invest only in securities which is prescribed by the SEBI regulations. It requires the mutual fund to be set up in the form of a trust under the Indian Trust Act. So another regulatory is the Association of Mutual Funds in India. With the increase in mutual fund players in India, a need for mutual fund association in India was generated to function as a non-profit organization. It is incorporated on 22nd August 1995. Apex body of all asset management companies which has been registered with SEBI. India has brought down the Indian mutual fund industry to a professional and healthy market with ethical lines, enhancing and maintaining standards. It follows the principle of both protecting and promoting the interest of mutual funds as well as their unit holders. What are the objectives of AMFI? To define and maintain high professional and ethical standards in all areas of operation of mutual fund industry, to recommend and promote best business practices and code of conduct to be followed by members and others which is engaged in the activities of mutual funds, to interact with the SEBI and to represent to SEBI on all matters which concern to the mutual funds industry, to represent to the government, Reserve Bank of India and other bodies on all matters which related to mutual fund industry, to develop a cadre of well-trained agent distributors and to implement a program of training and certification for all intermediaries and other engaged in the industry. So, what are the key constraints of mutual funds and how they are going to regulate it? So, sponsors, trustees, AMCs, asset management companies, custodians, RTA, and KYCs. They are the key constitutions. Sponsors. The application to SEBI for registration of a mutual fund is made by a sponsor. Thereafter, the sponsor invests in the capital in the form of AMC. Since sponsors are the main people behind the mutual fund operations, so eligibility criteria has been specified as follows. The sponsor should have a sound track record and reputation of fairness and integrity in all business transactions. Those requirements are sponsor should be carrying on business in financial services which is not less than 5 years. Sponsor should have positive net worth in all the immediately preceding 5 years. Net worth in the immediately preceding year should be more than the amount that the sponsor contributes to the capital of asset management company. The sponsor should have added profits after providing the depreciation and interest and tax in 3 of the previous 5 years, which is including the last year. The sponsor should be a fit and proper person for this kind of operation. The sponsor needs to contribute a minimum 40% of the net worth of the AMC. Further, anyone who holds 40% or more of the net worth of the shareholding in the AMC is considered to be a sponsor and should therefore fulfill the eligibility criteria mentioned above. Trustee. The trustees have a critical role in ensuring the mutual fund complies with all the regulations and protects the interest of the unit holders. The SEBI regulations stipulate that every trustee has to be a person of ability, integrity, and standing, a person who is guilty of moral turpitude cannot be appointed as a trustee. A person convicted of any economic offense or violation of any security laws cannot be appointed as a trustee. No AMC and no director, officer, or employee of an MNC shall be eligible to be appointed as a trustee of a mutual fund. No person who is appointed as a trustee of mutual fund shall be eligible to be appointed as trustee of any other mutual fund. Prior approval of SEBI needs to be taken before a person is appointed as a trustee. The sponsor will have to appoint at least 4 trustees. If a trustee company has been appointed, then that company would need to have at least 4 directors on the board. Further, at least two-thirds of the trustees or directors on the board of the trustee company would need to be independent trustees. That means it is not associated with the sponsors in any way. SEBI expects trustees to perform a key role in ensuring legal compliances and protecting the interest of investors. AMC, Asset Management Company. Trustees appoint the asset management company to manage investors' money. The AMC is return charges a fee for the services which provided, and this fee is borne by the investors as it is deducted from the money collected from them. The AMC's board of directors must have at least 50% of directors who are independent directors. The AMC has to be approved by the SEBI. The AMC functions under the supervision of its board of directors and also under the direction of the trustees as well as SEBI. It is the AMC which, in the name of the trust, floats new schemes and manages these schemes by buying and selling securities. In order to do this, AMC needs to follow all rules and regulations which is prescribed by SEBI as per the investment management agreement it signs with the trustees. The role of the AMC is to manage investors' money on a day-to-day basis. Thus, it is imperative that people with the highest integrity are involved with this activity. AMC cannot deal with a single broker beyond a certain limit of transactions. AMC cannot act as a trustee for some other mutual fund. The responsibility of preparing the OD lies with the AMC. Appointments of intermediaries like independent financial advisors, national and regional distributors, banks is also done by the AMC. Finally, it is the AMC which is responsible for the acts of its employees as well as service providers. Custodians. A custodian's role is keeping custody of the securities that are bought by the fund manager and also keeping a tab on the corporate actions like rights, bonus, and dividends declared by the companies in which the fund has invested. The custodian is appointed by the board of trustees. The custodian also participates in a clearing and settlement system through approved depository companies on behalf of mutual funds in case of dematerialized securities. Only the physical securities are held by the custodian. The deliveries and receipt of units of mutual funds are done by the custodian or a depository participant at the instruction of the AMC and under the overall direction and responsibility of the trustees. Regulations provide that the sponsor and the custodian must be separate entities. RTA. The RTA maintains investor records. Their offices in various centers serve as investor service centers, which perform a useful role in handling the documentation of investors. The functions of the RTA, which includes the processing of purchase and redemption transactions of the investor and dealing with the financial transactions of receiving funds for purchases and making payments for redemptions, updating the unit capital of the scheme to reflect these transactions, updating the information in the individual records of the investors, which called the folios, keeping the investor updated about the status of their investment account and information which related to the investment. The appointment of RTA is done by the AMC. It is not compulsory to appoint an RTA. The AMC can choose to handle this activity in-house. All RTAs need to register with the SEBI. KYC registration agencies. To do away with multiple KYC formalities with various intermediaries, SEBI has mandated a unified KYC for the securities market through KYC registration agencies which registered with the SEBI. Any new investors or grant holders, power of attorney holders, donors, and guardian have to comply with the KYC formalities. In person verification by a SEBI registered intermediary is compulsory for all investors. However, the investor needs to get IPV, that means in-person verification, done by only one semi-registered intermediary, which may be a broker or a depository or a mutual fund distributors. This in-person verification will be valid for transactions with other semi-registered intermediaries too. Distributors who have a valid NISM series mutual fund distributor certificate and a valid ARM can carry out the in-person verification if they have completed the KVD process. So now, till now we are knowing about what are the regulations which related to the mutual funds, and now we are going to observe about the Association of Mutual Funds in India. So which is incorporated in the year 1995, 22nd August. It is the apex body of all registered AMCs. All AMCs are its members, asset management companies. The Association of Mutual Funds in India is dedicated to developing the Indian mutual fund industry on professional, healthy, and ethical lines and to enhance and maintain standards in all areas with a view to protecting and promoting the interests of mutual funds and their unit holders. Objectives: to define and maintain high professional and ethical standards in all areas of operations of mutual fund industry, to recommend and promote best business practices and code of conduct to be followed by its members and others who are engaged in the activities of mutual funds and asset management, which is including the agencies connected or involved in the field of capital markets and financial services. To interact with the Securities and Exchange Board of India and to represent to SEBI on all matters which concern to the mutual fund industry. This I think already we completed this concept. Setup. The AMFI, the apex body of all the registered asset management companies, was incorporated on August 22nd, 1985 as a non-profit organization. As of now, all the 44 asset management companies that are registered with SEBI are its members. AMFA functions under the supervision and guidance of Board of Directors. So committees, there is a four committees are there. Committee on Valuation, Committee on Operations and Compliance, Committee on Registration of AMFA Certified Distributors, Committee in Financial Literacy. So what is the current status of the AMFI? The industry is in the institution building phase with setting the highest professional standards. It is enhancing credibility through the transparency of operation and frequency of disclosure. Consolidation through mergers and acquisitions. Product range, conventional and new generation funds, sector which is specific, index funds, exchange traded funds, fixed maturity funds, systematic withdrawal, and automatic redemption funds. So these are the types of mutual funds. It is by constitution, it is by investment object. So here closed-ended schemes, open-ended schemes, and interval schemes. Here equity funds, debt funds, hybrid funds, and money market funds. Again, equity funds classify into the diversified funds, tax saving funds, index funds, and sectoral funds. Since with the ending of the 1999, moved away from astute return schemes. Predominance of non-individual investor base, heavy concentration of investors from a limited number of cities, Emergence of independent research bodies evaluating performance and providing a rating of funds, generating investor awareness and investor interest in the industry. So these are the regulatory framework already completed. These are some of the standards which are related to the improvement in the operational areas.